Peachtree Case A, presented by Caitlin Sellier. Question 1. Why is the T-bond return in Table 1 shown to be independent of the state of the economy? The T-bond is shown to be independent of the state of the economy because they will be redeemed at par value regardless of how the economy is doing. T-bonds are issued by the United States Treasury and the government guarantees the rate of return. Is the return on a one-year T-bond risk-free? T-bonds are considered to be free of default risk because the Treasury guarantees the return will be realized regardless of the state of the economy. What must also be considered are the other types of risk that T-bonds are exposed to. Inflation must be accounted for as well as reinvestment risk. Question 2. The expected rate of return is calculated using the data listed in Table 1 for the state of the economy, probability, and return for the four alternatives. T-bond has an expected rate of return of 8%, TCO 13.5%, Gold Hill 8.8%, and S&P 500 Fund 15%. Based solely on the expected returns, the potential investment that appears the best is the S&P 500 Fund at 15%. Question 3. The table here lists the standard deviation and coefficient of variation for each of the four alternatives. For standard deviation, T-bond is 0, TCO is 11.72%, Gold Hill is 9.09%, and S&P 500 Fund is 16.43%. For coefficient of variation, T-bond is 0, TCO is 0.87, Gold Hill is 1.03, and S&P 500 Fund is 1.10. The standard deviation measures a portfolio's total risk. The coefficient of variation measures the amount of risk per unit of return. The coefficient of variation is the best measure of total risk because it considers the expected value as well as the risk per unit of return. How do the alternatives compare when risk is considered? Based on the standard deviation and coefficient of variation, the best alternative would be TCO. It has the highest expected return and the lowest coefficient of variation. Question 4. If an investor forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TCO, the expected return would be 11.15%, the standard deviation would be 2.89%, and the coefficient of variation would be 0.26. Both the standard deviation and the coefficient of variation are significantly less in the portfolio than in the individual stocks. This is because the stocks are negatively correlated. Gold Hill has a lower expected return and a higher coefficient of variation, while TCO is higher expected return and a lower coefficient of variation. By diversifying with two stocks, their levels of risk offset each other. If the ratio was to be changed to 75% Gold Hill and 25% TCO, the expected return would be 9.98%, the standard deviation would be 4.48%, and the coefficient of variation would be 0.45%. If the ratio was changed to 25% Gold Hill and 75% TCO, the expected return would be 12.33%, the standard deviation would be 6.89%, and the coefficient of variation would be 0.56. Both portfolios would still decrease the standard deviation and the coefficient of variation, but it would not be as significant as the portfolio that contained an equal amount of Gold Hill and TCO. The portfolio where these measures decrease the least would be the portfolio with the greater amount of TCO. However, the portfolio that has the highest expected return is the portfolio with the greater amount of TCO. Question 5. In a portfolio consisting of $10,000 in TCO and $10,000 in the S&P 500 Fund, the expected return would be 14.25%, the standard deviation would be 14.06%, and the coefficient of variation would be 0.99. This portfolio would not have the same risk-reducing effect as the Gold Hill TCO portfolio. The standard deviation of this portfolio is significantly higher than the portfolio in question 4. This is because the stocks are not negatively correlated. TCO has a lower expected return and a lower coefficient of variation. The S&P 500 fund has both a higher expected return and a higher coefficient of variation. Question 6. Suppose an investor starts with a portfolio consisting of one randomly selected stock and begins adding more and more randomly selected stocks. If the stocks are similar, the standard deviation of the portfolio will decrease as more stocks are added to it. A reduction in the standard deviation means that risk has been reduced. If a randomly selected portfolio of stocks will have lower risk than a single randomly selected stock, investors should choose to invest in portfolios. They should diversify instead of relying on a single investment. The goal is to earn the maximum positive return on the money they invest, so this would be the best way to do that. Investors should not necessarily think about the riskiness of individual securities, but they should think about the effect that securities risk has on the overall portfolio. They have already taken the first step in reducing risk by investing in a portfolio of diversified stocks instead of a single stock. They need to monitor the risk of their whole portfolio. It would be expected that this would affect a company's cost of capital because another measure of risk is beta. If the risk is lower, the cost of capital will also be lower. Total risk is the sum of the systematic and unsystematic risk of an investment. Diversifiable risk is specific to a certain asset or company. This risk can be reduced or eliminated by having a diverse portfolio. Market risk is the risk of the market as a whole. You should not expect to be compensated for holding a single risky stock. If it were that easy to invest in risky stocks and earn a high return, everyone would be investing in those stocks. If more people invest, the potential return from high-risk stocks is lower. This is why investors diversify. Question 7. These are the characteristic lines for T-bond, TICO, and Gold Hill. The slope coefficient for the T-bond is 0. The slope coefficient for TICO is 0.7, and the slope coefficient for Gold Hill is negative 0.3867. The slope coefficient is also called beta, and it is significant because it is an indicator of the risk of a stock or portfolio. The distance between the plot points and the regression line is significant because it indicates the distance between the predicted value and the observed value. It accounts for the error of estimating the y value with the regression line equation. Question 8. This is the security market line and a point plotted for TICO's expected rate of return. The required rate of return on TICO stock with a beta of 0.6 is 12.2%. Because TICO's expected return is greater than its required return, the stock is considered to be undervalued. Investors should buy TICO because it has the potential to increase in value. Question 9. If inflation expectations increase by 3 percentage points, the risk-free rate and the market return rate would also increase by 3 percentage points. Because of this, any required rate of return calculated with this information will also increase by 3 percentage points. TICO's required rate of return would rise to 12.2%. If an investor's risk aversion increased so that the market risk premium rose from 7 to 8%, the risk-free rate stayed the same at 8%, and the market return rate increased to 16%. This would increase the required rate of return for TICO from 12.2% to 12.8%. If the beta of TICO rose from 0.6 to 1.0, this would give TICO a required rate of return equal to that of the market return rate. They would both be 15%. Question 9 continued. The efficient market hypothesis is the investment theory that says it is impossible to beat the market. The impact it has on investing decisions is that it weakens the idea of earning returns from buying and selling over and underpriced stocks. This theory implies that stocks are always trading at their fair value and there is no room to capitalize on the difference. It is applicable to real assets because the market efficiency dictates the pricing of these assets. If they are over or underpriced, it may lead to the misallocation of these resources and a possible financial loss. The efficient market hypothesis has a big impact on corporate financing decisions. If a corporation's stock is over or underpriced, they may not have an accurate cost of capital, and this may influence their investment opportunity decisions. I do not think this theory should be a deciding factor in adding to Jake Taylor's staff of security analysts. Many experts have refuted this theory, and there have been people who have been able to consistently earn a return higher than that of the market. Question 10. What impact would a decreasing debt ratio have on TICO's riskiness? If the debt ratio of TICO is consistently decreasing, the riskiness of the company will also decrease. The beta will be lower, and that will cause a decrease in the required rate of return.